Hello everyone, welcome back to this YouTube channel, and today I'm going to be talking about venture capital. So if you're a founder looking to launch a startup, or you're an investor looking to invest within the startup space, or you are somebody trying to launch a career in venture capital, this video is going to be very helpful because I'm going to be breaking down what venture capital is, why do they even exist in the first place. So without any further ado, let's get started. So the first part I'm going to be talking about is what is venture capital. So venture capital is an alternative asset class, and by alternative asset class, they are investment that are not equities in public limited liability companies or bonds or real estate investment that we tend to categorize as the traditional investment. And so for venture capital firms, they're like financial institutions that tend to provide funding opportunities to early stage startups, and not just early stage startups, but early stage startups that are considered to be high growth businesses. So that means your small business that just wants to stay within a small space within a community and serve just a few customers may not qualify for a venture capital type kind of investment. So a critical factor for venture capital firms when they are considering investment in a startup is the growth potential of that particular startup. And as we go along in the video, I'm going to explain why growth is very critical to venture capital firms. Now, to move on, investing in startups is very risky. When I mean risky, it's very risky. In fact, research has it that 90% of startups fail within their first 5 years. About 70% fail within the 2 years to 5 years. That is when most of the startups fail. Now, most of the startups that tend to fail, they are startups that, if supported well, if provided funding, if provided coaching and mentoring opportunities, they could grow to become large corporate organizations someday. We hear stories of Facebook being started in a dorm room or an Apple being started in a car park. But when they started, nobody knew they are going to be something big. Now, at that particular stage, they have limited access to funding because of the high risk involved. They can't go to a bank to borrow money because a bank would really want a company that is very stable, that can generate cash flow in order to pay back the loan. Again, they cannot raise money from the public markets because they cannot be listed at that particular early stage. So where do they now turn to? They now turn to venture capital firms that have the necessary expertise, that their mandate is to support startups that are early stage and they are high growth startups. So that is why venture capital comes in to fill this particular void. Venture capital firms, coming back to why high growth is very much important, because of the high risk that venture capital firms tend to undertake in order to invest into the startups. They also require high returns to compensate for that high risk. So that means there is a direct relationship between the high risk and then the high returns. So whilst, let's say, a loan, for instance, the person will be charging an interest rate of 20% of the principal or 30% of the principal, that is not the case for a venture capital firm. They want to see multiples of their investment, like a 10x or a 20x or a 50x. It's not very uncommon to even see 1,200x. So that is pretty much an overview of how a venture capital firm tends to invest. Like I mentioned, they invest into early stage startups that have been identified to be high growth startups. And high growth is very critical for venture capital firm because of the desire to have high returns. Then the next question that you now be asking yourself is, how does a VC firm operate? How are they set up? But on the other hand, we also have the limited partners. So many times, here's the general partner, we have a skin in the game, which is like, let's say 1% of the fundraise. Let me use a particular example. Aroa Capital, for instance, in Nigeria has a $20 million fund that they have raised, right? So let's say the general partner, for instance, could have just contributed 1% of that $20 million just to have a skin in the game. But the other funds that will make up the $20 million is raised from a class of individuals, institutions that we tend to know as limited partners. So limited partners are mostly high net worth individuals, institutions like pension funds, and then like private equity firms. There's also the ones we call fund of funds or sovereign wealth funds. So these institutions tend to provide the venture capital firm with the money that they tend to invest into into the companies. So when a venture capital firm starts out, there is usually the period of fundraising, and depending on the nature of the market at that particular period in time is going to determine whether the venture capital firm is going to raise the money quickly or not. So between 2022 and 2023, there was definitely a funding scarcity, and many venture capital firms found it very difficult to raise money from institutionals. So that's for that aspect of the fundraising. So once the fund is raised, a fund is set up for a particular purpose, and that fund, you will definitely have a strategy to say, okay, for this fund that we are raising, we want to back fintech startups, or we want to back the next generation AI companies. And for that fund that has been raised, is going to be focused on looking for AI companies that are disrupting their space to invest into them. Then once the fund is fully set up, the second aspect that now kicks in is now deploying capital. So venture capital firms will actually have a period when they are deploying the capital that they have raised. So investing into startups, either maybe as lead investors or participating investors. And depending on the size of the fund, they will be writing different check size. So you could see a venture capital firm that their check size is like $500,000 or $1 million, or some that write very low check sizes like $20,000 or $50,000. It all depends on the fund that they raise. So at that particular point of deploying funds, one aspect that is very, very critical to venture capital firms is now managing the pipeline investments, such that they're actively sourcing the startup that they would like to invest into. So you see much at that particular period in time, they're actively involved in deal sourcing, going to events to find new startups. So some of them tend to launch, let's say, like an accelerator to attract the next generation founders. And most times you see different venture capital firms sharing deals amongst themselves. So the critical aspect is to ensure that there is enough deals to review, right? And then a selection is being made with which one they are going to be investing money into. So deal sourcing is one aspect that is very heavy at the point of deployment. Another one that is very heavy at the point of deployment is due diligence. Now, because of the high risk, yes, there is high risk when it comes to investing into startups, but VCs don't just write check like that and give to startups. So they will undertake a due diligence, looking at the products, looking at the traction generated, looking at the team, looking at all the different aspects of the business at that particular time, just to make the decision of whether they are going to invest in that particular company. And honestly, out of the total deals that come into a venture capital firm pipeline, most times they only invest, let's say, in 1% or 2% or even 3% of the deal. So usually the conversion rate between the deal pipeline and the startup that eventually gets investment is usually very small. So like I mentioned, in the second phase, in terms of deployment, deal sourcing is very, very, venture capital firms are very big on deal sourcing at that point. They are very big on due diligence at that particular point. So if you are a founder, this is the best time to be looking at what is the partner in that particular firm that you want to approach, what is the next event that they are attending, what is their email address, so that you can make your pitch. So the investment team, they are looking at startups, reviewing the startups for potential investment. So usually investment period, the cash deployment period will usually span, let's say, depending on the fund life. So most venture capital firms usually have a fund life. The average is about 10 years, right? So maybe the first 3 years will be earmarked for capital deployment. And once the capital is deployed, they now enter into a phase of portfolio management. And portfolio management is just all about supporting the startup that they have invested in. Now, one thing I didn't mention earlier is that beyond providing financial capital, another aspect that makes venture capital very, very attractive is in terms of the mentorship and coaching that they provide with founders. Bearing in mind that the failure rates for these startups is very, very high. Many of the startups, they don't even have many of the founders that set up the startup, many times they don't even have managerial expertise, they don't have leadership expertise, they just have a product and they are just technically skilled. So these venture capital firms, mostly their partners are sometimes past entrepreneurs, established professionals So they're able to leverage their network to support the startup. They're able to also leverage their knowledge to support the startup better. So that blend between financial capital and also knowledge capital is very, very critical to the success of the startup. And so that now leads me into the other phase of what a venture capital will typically do, and that is exit. No venture capital firm wants to stay in a company for a lifetime. Remember, I mentioned that a venture capital firm will usually have a fund life of, let's say, 10 years or 7 years or 8 years. At that particular point in time, they intend to exit all the companies that they invested in so that they can able to return back money to the limited partners. So that leads me to talk about exit. And many times venture capital firms exit a company either through, let's say, a merger and acquisition of that particular company. So let's say, for instance, in Nigeria in 2020, Stripe acquired Paystack for over $200 million, and a lot of the investors that invested in Paystack, they had about 200x of their investment. It all depends on the time they entered, they made the investment into Paystack. So exit is very, very critical to venture capital firms. So at that point, they are nudging their startups towards exit, maybe through a merger and acquisition or an IPO. Sometimes they tend to do secondaries or a partial exit. But the critical thing is that they need to see some liquidity so that they can return back money to their limited partners. Then another very important part of the venture capital firm at the point of exit is now returning back money to the limited partners. So that's where the fund is being evaluated based on certain performance metrics like distribution to paid-in capital, like TVPI, total value to paid-in capital, and all of these different metrics that is being used to evaluate a fund performance. Like I mentioned, this is supposed to be a high-level video. So based on the interest that I get from this video, if you're interested in learning more about venture capital, I plan to do a lecture series where I'm going to be breaking down venture capital, everything you need to know about venture capital. So if you're going to be interested, I would like you to hit the like button, subscribe, and also drop a comment in the comment section that you're interested in the lecture series that I'm going to be doing. So to wrap things up, venture capital firms are very, very, very essential in any space. Why? Because they tend to help startups that usually have very high risk of failure, right? Provide them with the funding capital that they need, provide them with the knowledge capital that they need in order to succeed. And like I mentioned, it's an alternative asset class that would be interesting for some investors that are tired of traditional investments that though may pose lower risk but have lower returns. So if you are looking to balance your portfolio, then venture capital based investments may be something you want to explore. So many approaches can be taken, either you investing into a venture capital fund or investing directly into the startup. So I'm just going to wrap it up there, and if you're interested in learning more about venture capital, let me see that in the comment section that you're interested. Thank you very much.